This video is going to focus on the second of the key areas in relation to financial management strategies, and that is working capital management. So the last video was on cash flow management, so really managing the cash in and cash out of the business. But this is looking at liquidity or working capital management of the business. And not surprisingly, that really relates to the controlling of current assets, the controlling of current liabilities, because that's what working capital is all about, and then strategies about how to actually improve the working capital or the liquidity management of a particular entity. So we'll start off with looking at control of current assets, remembering that our current assets are cash, stock, accounts receivable. Our current liabilities are bank overdraft and accounts payable, and then the strategies we'll look at are leasing and sale and leaseback. So just to recap on the working capital ratio, it's current assets minus current liabilities, or that's working capital, sorry. And working capital ratio is current assets divided by current liabilities. And remembering that 2 to 1 is considered to be a good ratio. And in the context of working capital, where you would at least want to have a positive figure, so more current assets than current liabilities, the size of that positive relationship is dependent upon the size of the business. Working capital are the funds used to run the business on a day-to-day basis. So it's cash. Cash is critical in that context, and therefore it's imperative that the business has a positive working capital figure. Another point there is that working capital often fails in the startup of a business, because the business is poor at managing its funds. It's not generating sufficient current assets in terms of cash, stock, accounts receivable to meet its current liabilities of bank overdraft and accounts payable, and that's when the business can get into problems. If it's got too high working capital, potentially too much inventory is being held, or too much idle cash is sitting around, and therefore, but conversely, if the business has low working capital, the customers and sales may potentially reduce, and there's not enough stock to sell to the customers. So that's a problem. So working capital management is really a balancing act between balancing the appropriate level of current assets and balancing the appropriate level of current assets in relation to current liabilities. So again, just to highlight up here, we've got the current assets of I Wish Toys, cash, sorry, that should have a figure there, of 25,000, and Qantas. There are some items on there which we don't really need to worry about, but just to get a sense of, they've got 3.4 billion in 2016 of current assets, a significant amount of cash on their balance sheet, nearly $2 billion worth of cash. So we know what our current assets are expected to be converted to cash within 12 months. And as we've said before, the business really must ensure that it's effectively managing its current assets to ensure it has stable working capital. And that'll help the business run its business on a day-to-day basis. So controlling your current assets, which is what we're looking at here, is all about managing your cash, your receivables, and your inventories. So managing your cash, analysing what the business can do to effectively manage cash, thinking about how it can do that, if that's through budgeting, a cash flow budget. And it's got to have enough cash for expansion and paying of debts, but doesn't want to have too much that's sitting around not being utilised effectively. So cash flow budget, I won't go into detail about that, but that might be something a business would want to use. So a budget which is showing the cash position of the business and what the business is expecting to use the cash for in the business in the next 12 months. Receivables or debtors is an important part of controlling your current assets, so managing your receivables and your debtors and making sure that money owed to the business is being paid appropriately, and that was part of our cash flow management in the previous strategy that we looked at. And the business must make sure that it's not tying up too much of its cash in accounts receivable, and it's effectively managing those receivables. Okay, in terms of potentially a credit policy, a business might needs to have a strong strategy for getting its debtors. And some of the decisions that a manager needs to make in the context of receivables are, when is factoring actually appropriate? When should we look to factor some of our accounts receivable? When might we need to send a letter to our lawyers to get the payment of those receivables, or to try to incentivize people to make those payments? When are we going to send a reminder to the customer? You owe us money. You have this debt owing to us. When are we going to screen out our debtors and not do business with those people anymore because they simply don't pay their accounts? When is appropriate time to offer discount for early payment? When might we need to charge interest on overdue accounts? Is it after 30 days, 60 days, 90 days? What is our actual policy on collecting bad debts? And then if none of this works, do they need to be put on a blacklist and effectively, like what we said earlier, not do business with them in the future? In terms of inventory, in the context of controlling current assets, this refers to stocks of raw materials, work in progress, and finished goods. So the stock you might have at the back of the store, stock that a business might be manufacturing but is not yet complete, but also the items that are complete. Certain inventory levels are critical for a business because it needs to make sure it's got the appropriate level of stock that it can meet the needs of its customers. If it doesn't have enough stock, that's going to turn some customers away because, oh, sorry, we can't sell that to you today because we actually don't have enough in stock. But if you've got too much stock, the business is tying up too much capital in stock, sitting around doing nothing and only facing obsolescence and deterioration in that particular stock. So it's a real balancing act for a business. And then a business controlling your current assets, one of the key parts about it is managing your stock levels. One way to do that might be through something like just-in-time. So just-in-time is the process of only having stock on hand as needed. It's a bit of a risky strategy because you need to be able to time your receiving of stock so that it can meet the customer demand instantaneously. But it might be something a business considers doing to better manage their inventory levels. Okay, that is it for the control of current assets. The next video will focus on the control of current liabilities.